Students, we're going to be learning about accounting today, and make sure to follow along with me so you can get a good idea of how to get through today's assignment. So to get started, you are actually going to need to download this document that is in the Canvas page. It's called the Accounting Workbook. So if I come into the Canvas page, you're going to see the Accounting Workbook, and if you scroll down to instruction number 3 and click on Accounting Workbook, you're going to get this Google Sheet. You're going to go ahead and hit File, and you're going to make your own copy of that. And then you're going to be editing your own copy. In this lesson, we're going to be learning about the accounting equation. What is the accounting equation? We're going to be learning about what's a balance sheet and as well what's an income statement. So we'll be working on this lesson, and I'll help explain and help you get through this throughout the Nearpod that we're going to be going through right now. So once you have that done, you will go ahead and move on. An accountant makes about $53,000 a year. The starting salary averages around $50,000. Now, mid-career, as the accountant gets more experience, is around $67,000 a year. So an accountant job, and it is in very high demand. You do need a 4-year bachelor degree, and then if you want to move on and earn even more money, you can get a master's degree and get a certificate, which is called the CPA, which with that CPA license, you become a certified professional accountant, and you can make even more money than $67,000 when you become a CPA, or you can also work your way up as an accountant to other positions like the head of accounting, which is called kind of your controller or your chief financial officer at businesses. So this is just the starting. You can continue to make a lot more in this career. So let's learn a little bit about accounting. First of all, we're going to learn about the accounting equation. But in order to explain to you what is the accounting equation, I need you to understand some vocabulary words. First of all, assets. Assets are resources owned by the company. So these assets they could be sold and turn into money later on. So they do have some type of positive value to the company. So it could be cash. It could be money that you're receiving, or it could also be your inventory, so products you have that you can sell for money. It could be land, that could be sold for money. Vehicles could be sold for money. Investments, obviously, is money. So these are all things that are of positive value that can be turned into money. Right here, it's asking you, if you were following along with me in class, what is an asset, and you give me that answer. But if you're not, because you're in this video, then just continue on with me. We're going to learn what's a liability. A liability, though, is the opposite of an asset. Liability is an obligation of a company organization. In other words, it's your debt. So accounts payable, which means things you need to pay money on. Loans, paying your mortgage, paying taxes, paying employee wages. And I want to backtrack. I want to make sure you understand the difference between accounts receivable and payable. Accounts receivable is money that people owe you, so they need to pay you. So you plan on this money coming in because you know people owe you this money. For instance, let's say you have your utilities or your internet service. So every month, your internet company knows that you're going to be paying them. They charge you a bill. They say, all right, this money is going to be coming in this month because we just charged them and we're giving them this service. So accounts receivable is money that's going to be coming in that you know is going to come in. Accounts payable is money that you know you have to pay. All right, now let's move on to equity. Equity is capital amassed by the company after all liabilities are subtracted. So equity can be liquidity and cash. So for instance, equity is after you take all your assets and then you subtract all your liabilities, whatever you have left is what you have left because you basically took your assets. That's what you have. You took your liabilities and subtracted those out, so all your debt's out, and then whatever you're left over with is your equity. So it could be your profits, it could be stocks, it can be just cash or any investments you have, any other type of assets you still have left over. All right, liquidity. It's a company's ability to pay its bills from cash or from assets that can be turned into cash very quickly. So cash, obviously, if you have liquid cash, you can pay for something quickly. But maybe if you don't have enough cash, you can hurry and sell something, and then you can sell some of your supplies and you get some cash. You can sell your property and get cash. You can sell some stocks and get cash. You could know, oh, this money's coming in, so I'm going to have cash soon. So liquidity is the ability to have money fast. So for instance, I could own a company and I could own a bunch of buildings. I could own 10 buildings. And I don't have much cash per se, maybe. So if I own a bunch of buildings, but I don't have much cash on hand, that means I have low liquidity. Liquidity would be things that you could sell easily. So a lot of times businesses do have cash because they need to have a liquid asset to be able to quickly pay for something or buy something instead of having to go sell stock or sell some supplies or sell some other type of equipment or a property. So liquidity is though something that you can sell quick and turn it in quick into cash and then you're able to have cash on hand. All righty, now that we've gone over what's an asset, what's a liability, what's equity, and what's liquidity, I can explain to you what's the accounting equation. So the accounting equation is this: assets equal liability plus equity. So in other words, if you take your liabilities and you take your equity and add that together, that should be the same as your assets. Well, in other words, you could take your assets and subtract your liability, and that would equal your equity. And the best way to explain this to you is to actually give you an example of what that is. So right now, I'm going to give you that example. If you were with me, you would go ahead and put in the accounting equation, but you're not with me. So again, here's an image of assets equal liabilities plus owner's equity. Before we move on to the balance sheet in part 2, we're going to take a break, and we are going to now open up our accounting workbook. And on the accounting workbook on the bottom, you're going to notice there's 3 tabs. We're going to go to the accounting equation tab, and we are going to do some calculations to figure out, to make sure you understand the accounting equation, that our assets equal liabilities plus owner's equity. And we're going to do some math to figure this out. So I have 800 in assets and 300 in liabilities. Thus, 800 minus 300 would be 500. That's my owner's equity. So again, owner's equity plus liabilities should be the same as assets. Same thing here. And if you can't do it in your mind, you can go ahead and type in a calculator and pull up a calculator on your computer. So I could go 2100 minus 1200, and I can see 900 should be the answer. I'm going to put that in. Now, you are going to go ahead and, that's the wrong answer there. I just wanted to see, it's always going to come in bold whatever you put in, whether it's right or wrong. So make sure you do your math correctly with your calculator to get it put in. So you guys are going to go through and you are going to do each of these 15 transactions. At the bottom, it's going to tell you have 15 out of 15 when you get them all inserted. So I'm going to give you a moment to go ahead and go through and do all of them, and then I'll get back with you. Okay, I'm back with you, and you should be done with the accounting equation. Moving on. So as we move on, we are going to now look at part 2. What is the balance sheet? And the balance sheet is going to be, actually, you guys were just having a little look at the balance sheet kind of in terms, and we're going to be doing a little more exercise in a sec on the Google Sheet. But let's take a little overview of what's the balance sheet. Financial statement that summarizes a company's assets, liabilities, and shareholders' equity at a specific point in time. So remember that what we owe is liabilities, what we have is assets, and what we're worth is our equity of our company. We're going to show this on the balance sheet.
What is a balance sheet? Presented by WallStreetSurvivor.com. A balance sheet is a snapshot of all the assets and claims to assets a company has at a given point of time. A balance sheet has 3 sections: assets, liabilities, and equity, which must always be in balance. Here's why. Every company has a number of resources, some owned and some borrowed. Resources that are owned are considered assets. Resources borrowed are considered liabilities. Here's Wayne. Wayne owns a chain of profitable cowboy gear stores in Texas. The Cowboy Hut is not a publicly traded company, so financial statements are not required. But Wayne has some private investors who feel preparing a balance sheet will be helpful to get an idea of the net worth of the company. Wayne begins counting all his assets, starting with the most liquid. Liquidity means how quickly he could sell his assets if he needs to. Wayne counts $50,000 in cash. He also notes he has $20,000 in payments due from customers paying on credit. He files that under accounts receivables. Finally, Wayne adds $50,000 in inventory and sums all of those up as current assets. Next, Wayne counts that the Cowboy Hut has $600,000 in property from their retail stores. This is a long-term asset. On the flip side, Wayne also begins to count up all the liabilities or claims to the company's assets. Like the assets section, he lists them in order of liquidity. First, he records all the bills he has to pay to his suppliers. These are the company's accounts payable. He also records the rest of his other current liabilities, like his line of credit. To pay for the company's retail store, Wayne took out a $300,000 loan from the bank. This loan is filed under long-term liabilities, since Wayne will pay back the entirety of the loan over a long period of time. In the final section, Wayne records the Cowboy Hut shareholder equity. First, Wayne records the par value of the shares issued to the investors of the company. This is done by multiplying the number of shares issued by the share price. Lastly, Wayne adds the company's retained earnings. Retained earnings is the cash left over after operations, or profit. Retained earnings is the link between the balance sheet and the income statement, which records revenue and expenses.
As you can see in this example, the assets right here, total assets equals $720,000, and then the liabilities. So we take our liabilities, we equal $340,000, and then plus our equity. Our equity is $380,000. So if you take $380,000 plus $340,000, that gives you $720,000. In other words, assets equal liabilities plus equity. So liabilities and equity add together to make the same as assets. And by doing that equation, you get the exact same, and we're going to go back and show you, you get the exact same calculation of the accounting equation, which is assets equal liabilities plus owner equity. So again, assets equal liability plus owner's equity put together. All right, now let's look at some examples. Helen wants to go to college. She borrows $10,000 from her parents to pay her first year of school. So Helen has $10,000 in cash, which is an asset now. But she also has $10,000 in liability because she has a loan to her parents. So her assets is $10,000, but then also her liabilities is $10,000. They equal out. That's a simple example. 6 years later, Helen has finished school and has been working in her career. Helen has paid off all her loans and doesn't owe anyone any money. She has zero liabilities. Helen has $150,000 in cash. This is her asset. So she's got 115 asset. She has zero in liabilities. But is also her total equity because she has no liabilities. So her liabilities is zero plus her equities, which is $150,000. So she has $150,000 in cash, and that cash also counts as equity. So 150 and 150. She has 150,000 in assets, and that also is equity that she owes because she has no liabilities on it. Let's go to a little more complex example with Helen. So now she wants to buy a house for $350,000. So she takes that $150,000, which is her asset, and puts it as a down payment on that house. She also needs another $200,000 for the rest of the house, so she gets a loan. That becomes her liability. So Helen still has $150,000 of equity because she basically took that cash and turned it into money on her home. So it's still equity. What we're seeing as Helen has $150,000 of equity because that is what she has left over after she subtracts her liabilities from her assets. So Helen has $150,000 equity now on the house, and $150,000 that cash came from. So if we look at the accounting equation, how much is her home worth? Her home is worth $350,000, and now that she owns that home, so over here on her assets, she has $350,000 in home. That's what the value of her home is. It's an asset. It's worth $350,000. So then if we come over to the equity, she has $150,000 that was cash that she owns on the home, and then $200,000 is the liability. So you take the $200,000 of the liabilities plus what she doesn't owe, which is hers, which is $150,000. So that makes $350,000. So again, she has a $350,000 asset, and then she also has $350,000 in liabilities and equity when you take what she owes compared to what she doesn't owe and put it together. So as we look at the accounting equation, let's go even more in depth with the last example. 10 years later, Helen is ready to sell her house and buy another one. She still has the $150,000 in equity. From her original loan of $200,000, she still owns $160,000, which gives her $40,000 in added equity. So now she goes $150,000 plus $40,000 in equity, which means $190,000. So now she's got $190,000 in equity and $160,000 in liabilities or debt. She sells her house for $400,000. So she pays the bank. So she actually sold it for more than what she bought it. She got another $50,000 in equity we're going to see. So she pays the bank the $160,000, and she's left with $240,000 in equity because she got $190,000 right there from money that she's just put into it, and then plus she got another $50,000 because the property went up in value. So now she's got $240,000 in equity. So she buys a new house for $600,000. She takes all that $240,000 and puts it on this new house, and then she has to get a loan for $360,000 to pay up the difference. So now her asset is at $600,000 because that's what her home's worth. And then her liabilities is $360,000 because that was her loan. And now she has an equity amount of $240,000 right here. So here's an example of an actual company. Companies are required to show you how much they're making every so often. They want to show shareholders and investors, which are shareholders, and usually every 3 months or every quarter, companies are going to come out with their balance sheet and show how they're doing. So here's an example of Apple's balance sheet. We can see right here that Apple shows all of its assets and its total assets right here. As you can see, here's their total assets. They keep growing. Then we see their liabilities. Their liabilities are right here. So we'll look at the 2015. They have 290 million in assets and they have 171 million in liabilities. And then we have the stockholders' equity. In the stockholders' equity, we have 119,000. So essentially, if I was to do my math, and I'm going to pull up a calculator to show you, I would take 209,479,000, so 290 million, and I would minus 171,124, and then I'd also minus the other amount, which my math did not work in, so let me put those numbers in again. So essentially I'll bring over a calculator and we'll do the math right here. 290,479 minus 171,124, 123. And then look, that's that 119,355. So in other words, my point of what I'm showing you is that if I take the liabilities, which is right here, and I add in my equity, it's going to make the same amount as my assets. So assets equal liabilities plus equity, like you can see in this example. So again, in summary, your liabilities plus your equity should be the same amount as your asset. So let's go ahead and transition back over to our Google Doc, and we're going to look at the next section inside of our accounting booklet. So on the bottom, go ahead and click on the middle tab called the balance sheet, and we're going to work on the balance sheet. I'm going to zoom out a little so you can see it all. So here we have a balance sheet for ABC Corporation. We have our assets here on the left, and we have our liabilities here on the right. So to work through this document, we're going to use some of our Google tools to do some auto adding for us. So here we have our cash, our accounts receivable, and our inventory. We want to add that all up. So I'm going to come over to the equation button and find sum. And I want to auto sum these three together and get a total. So right now my current total assets is 45,000. Now I want to look at my long-term assets, and right here in the long-term assets, I'm also going to do the equation button and sum. We're going to add up my land, my buildings, and my equipment to see how much I have in long-term assets. So we have 45,000 in current assets plus long-term assets of 175,000. I'm going to go a third time and use the equation and use the sum, and I'm going to add up my current assets, and then I'm going to type in a comma, and I'm going to put in my long-term assets to get a total. So I have a total of 220,000 assets. Now, again, my assets should be the same as my liabilities plus my owner's equity. So let's do the math here. Again, I'm going to use the sum. 700,000 plus 950 is the total. Going to use the sum equation. We have 70,000 plus 20,000, which is 90,000. So we have our total liabilities with the sum button again, which is 7,950. I'm going to type in a comma here to also add in the 900,000, and that gives me a total liabilities of 97,950. All right, let's go add up our total stockholders' equity. So we're adding up our common stock plus our retained earnings, and we have 122,000. So remember that this number plus this number should be the same as this number. Well, let's put in the math and see if it works. I'm going to come here in the net tangible assets, which is your liabilities plus your owner's equity. I'm going to do the sum. We're going to take the total liabilities, comma, total stockholders' equity, enter, and look, they match up. My liabilities plus my owner's equity, which is known as net tangible assets, should be the same as my assets. So you guys saw me do one. You're going to scroll down and you're going to do ZYX Corporation and see if you can come up with the calculations on your own, and I'll be back with you in a sec. Okay, hopefully you finished that all up and now you're ready to move on to the next section. We'll be looking at the income statement next. I'm going to go ahead and minimize that Google Doc, and we are going to now look at part 3. What is the income statement?
An income statement shows the financial performance of a company for a given time period. It shows a company's revenue and costs and is therefore a pretty good indication of the strength of the company. Income statements are also called profit and loss or P&L statements or revenue and expense statements. Income statements are prepared as a part of a company's financials. All public companies are required to submit them quarterly, regulated by the SEC. So let's look at a simple income statement in practice. Here's Mary. Mary owns her own successful flower shop, Petals, and has begun filing her income statements for the quarter. Last quarter, Mary sold $500,000 worth of flowers. This is her top line revenue. Revenue is also sometimes called sales. Next, Mary needs to add up all the costs directly associated with cultivating her flowers. These costs include things like seeds, earth, fertilizer, and electricity. These are added together and are collectively known as costs of goods sold, or COGS. Revenue minus COGS is known as gross income. Think of this as money made from both growing and selling flowers. After that, Mary adds up her non-direct costs. These are costs she incurs that aren't related to sales. Petals' costs included marketing, rent, and salaries to her 2 store managers. These costs are known as selling, general, and administrative costs, or SG&As, and are often thought of as the company's overhead. Gross income minus SG&As is referred to as operating income, or income earned from a company's operations. Mary subtracts taxes from her operating income to get her net income. Mary now has a good understanding of the profit generated from Petals. Usually, income statements are a little more complex to put together and are handled by professional accountants, controllers, or CFOs, and follow the general accepted accounting principles.
So as we learned, the income statement is a financial statement that measures a company's financial performance over a specific period. And it's your revenues versus your expenses. So revenue is what we earned, and what we spent is our expenses. So let's look at a company called Yum Brands. This is a real company, and we're going to see how their expenses match up with their revenue. And just so you know, Yum Brands owns a lot of companies or restaurants you've been to. They own KFC, Pizza Hut, Taco Bell. They own a lot of restaurants. Anyways, let's look at this example in their income statement. We can see that their profit was right over here, and then we can see their operating income or loss. So these are their expenses, and then we'll see their net income as well here. So if we look at this carefully, here's their profit. For instance, we'll look at 2015, December 26th. It's $3,746,000. And then they had operating income, which was right here of $1,921,000. So if I take this number and I subtract this number, so I'm taking my revenue, I'm subtracting my expenses, then I get my total net income, what I really made. So this is how much money came in, but then I paid all my expenses, and that's what I'm left with as my actual profit. So we can see my gross profit, and then my operating income or loss, which was my expenses, subtracted that, and then I got my total income. So you can see over time, in 2013, this was their total net income, and then they went down a little, and then they went back up. So as we always want to see that a company is increasing, and the income statement shows that your profits are increasing. So here's another example of an income statement. And we can see the revenue right here. The total revenues is for this music company is $27,000. And we can see the expenses. So this is the products that they had to buy. This is their depreciation. This is wages, rent, interest. They have all these expenses, and their total expenses were $14,850. So we take the revenue, subtract the expenses, then we get their real total net income of what they actually earned. So you are now going to go back to the Google Sheet, and then inside of the Google Sheet, which is called their accounting workbook, we are going to go to the income statement. So I've given you an example of one right here on the Rita's corn dogs. We can see her revenue, we can see her assets, and then we can see interest from investments. She has a total revenue of $185,200. But then we have all these expenses, the actual food she had to buy, her insurance, paper supplies, utensils, office, cell phone. You're seeing all these expenses right here. Taxes. So her total expenses are right here. And if we take this number, our revenue, we subtract it from our expenses, that's what our actual profit is. I'm going to do another one with you on the right-hand side. I'll remind you how to do this. Use the counting equation right here, and I'm going to grab the E, and then I'm going to hit sum, and I'm going to add up all these together, and then I'm going to hit enter. So there's my total revenue. Then I'm going to come over to my expenses and figure out my expenses by grabbing the E equation. I'm going to add up all these to get my auto sum feature to add up all my expenses. All right, now with all my expenses, we're going to do a little different equation. We're going to manually put these on. So I'm going to hit equal sign to tell Sheets that I want to do an equation. And I'm going to take this number, my revenue, and I'm going to subtract this. I type in minus. So I'm taking H11 minus whatever's in cell H26. So H11 minus H26, let's get the total. And it's 59,627, but look, it has parentheses around. What does parentheses mean? Well, parentheses mean a loss. Because if you look at this, my revenue is less than my actual expenses. So sometimes a company has a net income a net loss instead of a net income. That does happen. Sometimes a company is losing money, and this is how you see it. So you guys are going to go through and do all of these. You can do these two I just showed you. Actually, read his corn dogs done for you as examples. So you'll do Al's used cars, and you'll scroll down to Kim's driving school and Joe's snow cones. And when you are done with that, you will then come back into Canvas. So here's Canvas, and you are going to be submitting. So right here, number 5, when you're finished, you're going to submit your accounting workbook to this Canvas page, and then you're going to hit next to take the accounting assessment on the next page, which